Welcome back, everyone, to another episode. We are finally going to update these four different charts that you guys like to follow along with me every single month. My annual dividend income, my monthly dividend income, my portfolio value, and my monthly YouTube income. So let's go ahead and update all four of those right now. So for my annual dividend income, as of the close of September 30th, my portfolio now makes me $196.84, and there it is updated right there. There's the before and there's the after. Now let's go ahead and look at the real income that I received in the month of September 2020, and let's go ahead and put it in right now. I received $16.10, a new all-time high for the portfolio. I made a lot of big deposits these last 2 or 3 weeks, so a lot of it hasn't had time to make it into the shares. It'll be claimed in the ex-dividend, and I'm sure when we get to December, it is going to be much, much higher than $16 on the next big round of dividends. But let's go ahead and look. Here's the before, and there's the after. And then let's go ahead and look at portfolio value. So portfolio value, like I said, I usually deposit $100 every single Monday, and I deposited an additional $1,000 on top of my 100 that I deposit every Monday. And here it is updated in the chart right here. There you go. We went from 3,738 to 5,475. And there's the before, and there's the after. The portfolio is getting up a lot in value. Now, next up, and last but not least, we have the monthly YouTube income. And I was really surprised with how impressive this monthly YouTube income was. Because last month, right here, we made $375.56. Now, $375 already for me, being a part-time college student, is life-changing. The amount of money that I can save is already very limited. So $375 just absolutely blows any amount of money that I thought I would ever make from this channel out of the water. And then we got to this month. This month, we made $687.92. Look at the jump up. Here's the before, and here's the after. Look at that massive jump up in the amount of money that my YouTube channel brought in, and who I have to thank for that is you guys watching. If you're watching this channel, if you watch an ad at the beginning or in the middle of this video, you're the one that helped financially support this. I also made money from different categories, like I break down right here. This is updated. So my mentoring fees, I have mentoring calls, link in the description and information down below if you needed to know about that. Ads from the channels, like I said, the ads that you see, M1 finance referrals, credit card referrals, and then a $10 donation to the channel. Overall, we brought in $1,568 from the channel, and then after expenses, you're looking at $1,184.40 in total profit. But overall, guys, we'll go ahead and break down my portfolio like I do every single month for those of you that are new to the channel. If you're wanting to see how I make those charts and how I track this income, I own it through these multitude of dividend stocks, and I currently own 27 different stocks. And if you want to support me and my channel, if you want to help get this number, hopefully to even 700 the next month, you can use this referral link that is down in the description. You get $10 just for getting signed up with M1 Finance, and like I said, there's other things in the description as well, such as like a Yada savings account, credit card referrals, mentoring calls, anything like that down below. Go ahead and check out the description. Everything you need to know is down there. But we will go ahead and go one by one from largest to smallest, my biggest to smallest holdings in my portfolio, all 27 stocks that I own. Now, if we go to my history here before we get started with that, let's go ahead and sort by dividends. So the dividends that I received in September are including Visa, Discover Financial Services, Honeywell, Johnson & Johnson, Southern Company, IBM, 3M, McDonald's, Realty Income, Whirlpool, Duke Energy, Home Depot, Waste Management, Qualcomm, Broadcom, Pepsi. Now that is a lot of different dividend stocks, and I want to let you know that I now hold 27 stocks, but in the beginning of September, I actually held 27. Two of these stocks I just sold out of. I just sold out of IBM. I made a video about that previously. Go check it out if you're interested in that. And then I also sold Whirlpool, and then I also increased my position in WP Carey and lowered my target weighting in Caterpillar just a little bit. But in the month of September, I made several deposits like I mentioned. I make my typical $100 deposit every single Monday, and then I also made an additional $1,000 deposit. That's partly due to the big jump up here in the graph right here. Now, if we go back here to this activity feed and we sort just by cash movements, it shows you all the referrals that I received in September, and so many of you guys signed up using my referral link. So thank you guys so much for watching. If you supported me and you help support my channel and help support my investing strategy, I really appreciate all the love and help from you guys. But overall, let's go ahead and just get started. And let's go ahead and start with my number one investment, Broadcom. So Broadcom is currently now worth over $500 in my portfolio. It has an 8% target weighting. On a money-weighted return, we were up 46.37%, and I'm currently up $84.31, counting dividends and market gains. Now, right now, today, for pretty much every single stock in my portfolio, There was just a big announcement in the stock market that took it deeply into the red, and Broadcom is no exception. But this stock is a very great stock for both growth investors, for dividend yield seekers, and dividend growth investors, because this stock just has a multitude of different things going for it that make it very attractive, including its growing dividend from 44 cents all the way up to $3.25 in the last 5 years. And then a number of other things as well. The fact that it has a dividend yield of about 3.5% right now, including the down day today, and they are due for a dividend raise in just a couple of months from now. So if you're wanting to invest in it now, its dividend yield will more than likely even be higher than the number it's showing right now. So if you're wanting to invest in Broadcom, they have one of the most valuable partners in the world. They have a huge part of the revenue coming from Apple. They make the microchips for them. And then they also have a both software and hardware business that is growing on both sides. They have their hardware business with Apple and then other partnerships as well. And then they also have a software business from Symantec that they bought out recently. And this company is still growing revenues in the high single digits. And I think with the growing category, with the diversification of revenue streams that they have, and their awesome stream of cash flow, I think that they'll continue to pay and raise dividends, and also the share price will probably increase in the long run. Now, the second largest stock in my portfolio is Realty Income, and I'm currently up 36.12% on it. It's 7% of my portfolio, which means I'm up $59.16 on it, and Realty Income is one of those stocks that I believe every single dividend investor should own. They do not pay dividends quarterly and do not raise annually. They instead pay dividends monthly and raise quarterly. So you will be getting cash flow much more frequently, and they just raised their dividends again just about 2 weeks ago, up from 23.35 cents to 23.4 cents. It's very small raises, but they give you 4+ raises a year. So very frequently, and basically, they're just the most well-run real estate investment trust in the stock market, in my opinion. If you're investing in Realty Income, you're diversified between 6,500 different properties through hundreds of different clients. Nearly all of them are investment-grade tenants and very safe, successful companies, and Realty Income is going to get the profits as they raise the rents off of those clients, and they continue to appreciate in value from the properties that they sell to those clients. But if we go back here, let's go to my third largest investment. My third largest investment is the Southern Company. It makes up 6% of my portfolio. I'm currently up 11.69% on it. And that 11.69% that I'm up works out to come out to $19.56 worth of gains. Now, Southern Company is a very high-yielding utility stock. I like to throw this in there just because I think it's going to be very safe, very conservative, a lot more stable than that in traditional tech stocks or a lot of high growers out there. It gives an incredibly high yield of almost 5%. And this utility stock is very safe since it's very safe and stable and government regulated. And basically the way I look at it, this is one of those companies that is a need-based company, and people are always going to pay their electricity bill before they pay just about anything else. They're always going to have safety and security and food on the table before they worry about buying the new iPhone or before they go out and start spending discretionary spending. Utilities like natural gas and electricity is very important for pretty much every household out there, and Southern Company is the one to profit from that. Now, if we go next down on the list, the next stock makes up 6% of my portfolio as well. It is Visa. I am up 21.62% on it, which makes up $31.80 worth of gains. Now, Visa is the lowest yielding stock in my portfolio, but I'm very bullish on Visa. And every month I bring this up. Over 85% of the world's financial transactions are still done in cash. So this is why you see a lot of competitors like companies like Square as a very decent competitor to Visa. And this stock has went to sky-high prices and it's trading at an incredible valuation. And I believe Visa in the long run is going to do the same thing. I don't even think they're anywhere near close to being done with their growth story. I just love the business model. I love the impressive margins that they get. And they have so much room to raise that dividend and grow that dividend in the coming years. And they are due for a dividend raise here in just the next couple of months. So if you're investing in Visa, invest in it for the long term for both a growth play and a dividend growth play. Next up in the portfolio makes up 5% of my portfolio. I just bumped it up considerably, and I actually even bought more than what's 5% target weighting. WP Carey is the second real estate investment trust that I own. I own 3, which is Realty Income, WP Carey, and Store Capital. And WP Carey, I am so bullish on right now, considering the dividend yield and the price that it's currently trading at. Now, this stock is still retaining 98% of its rent that it was at the beginning of the year. 98%. So they've only went down 2% of the amount of rent that they would be receiving at full capacity. Now, the fact that they're still down to $67 and this used to be trading at $93, This shows that, in my opinion, that this stock is not being valued correctly. Why would they value the stock at $93 in the end of 2019 when they're receiving almost the identical amount of profits and revenues that they are today, but now the stock is 20-30% lower? This stock, in my opinion, is a pretty safe dividend stock considering it's a REIT as well. It made $1.14 in adjusted funds from operation, but they only paid out $1.04 in dividends. They raise every single quarter, and they've already raised their dividends 3 times. That's right, you heard me right. They've raised their dividends 3 times in the year of 2020, and I'm sure we're about to see a fourth. I think that this company is extremely undervalued, and if you're wanting to buy a real estate investment trust right now, you got to be looking at WB Carey. It is a steal in my opinion, and I think they'll be successful for the long term as they're diversified between Europe, the United States, all different categories with industrial and office space and retail and all other categories. I think there will be a safe buy for the long term. JP Morgan Chase is 5% of my portfolio as well. I've turned very bullish on this bank as the share prices went down considerably from the recession. I'm up 6.3% on it, which makes up $5.61 worth of gains. If you look at the 5-year chart, you see a very fast growing dividend, over doubled up from where it was 5 years ago. It pays 90 cents a share today, and this used to pay 44 cents. Now this is almost a 4% yielding stock. Now regardless of the dividend, do you think that JP Morgan is going to be around 10 years from now, 20 years from now? I think so. They're a very adaptive bank and very smart with the balance sheet that they have. I think that JP Morgan is going to be just fine for the long term. Now, if you're bullish on banks in general and you think a company that is financially healthy as JP Morgan is going to be around, you should invest in it and take advantage of that growing dividend that is probably going to get right back to being raised every single year right after we get past the year of 2020. But JP Morgan, I'm very bullish on, and I've increased my position in that quite considerably over the last month or two. Now, the next stock in my portfolio also makes up 5%. I'm currently up 11.84% on it, or $13.65 worth of gains. Now, 3M is a company that is a very safe, stable dividend stock that has been around forever. This stock has over 50 plus years worth of dividend raises, and whether you know this company or not, you probably use them every single day or at least every single week. They make 56,000 products. You heard me right. 56,000. Basically, this company is going to grow alongside as the economy grows, as we increase our GDP, the population goes up, and between their 56,000 products, while they might always have a couple thousand that are struggling, the vast majority of them are always profitable and growing every single year. And so this share price got way too ahead of itself back in 2018, 2017, and now it's come back down to earth, and I'm buying it at rock bottom valuations, considering how impressive of a dividend track record this company has. And 3M is a company that I'll probably own until the day I die or until I'm a very old man. Now, 5% of my portfolio has also been increased towards Johnson & Johnson. I am currently at 5.31% on it. $4.84 is what I'm up on it. And the same thing when we talked about 3M being a safe, stable dividend stock, Johnson & Johnson has arguably, in my opinion, the best track record of any company, period. And I'm not talking about healthcare companies. I'm not talking about dividend stocks. I'm talking about any company. This company has been around forever, and I think that they're going to continue their streak of increased profitability pretty much every single year like clockwork. And if you want to talk about a stock that has paid dividends throughout any time in history, this is the stock you want to refer to, because this and a few others is one of the few that even paid out dividends through not only the Great Recession, but the Great Depression. That's right, the Great Depression back in the 1920s and 1930s. This stock has increased dividends every single year for about 50 years plus, and they just bought out another pharmaceutical company called Momenta, and this is how a lot of these healthcare giants grow, is they just buy out a lot of lower pharmaceutical companies, and that's how they continue to grow their revenues every single year. And I think that management is excellent behind Johnson & Johnson. And one more piece of information I want to throw at you with J&J is that they're one of only 2 corporations on planet Earth that have a AAA credit rating. So if that doesn't tell you anything, they are safer to invest in for their bonds than the United States government based off of the credit rating. So pretty impressive there. Next up, we have Pepsi. It is 5% of my portfolio as well. I am up 8.79% on it, or $11.57. Now, Pepsi, just a couple days ago, just reported its earnings, and it's down quite heavily today. Wow, look at that, buying opportunity. It just reported its earnings the other day, and their numbers came out showing that their snack foods were growing at a very rapid pace. Now, this company just announced that they're releasing Driftwell, which is a sleep aid product beverage that is going to be released by Pepsi in December, so about 2 months from now from the time I'm filming this, just one more product for them to increase revenues. And if that's not enough for you to get interested in Driftwell, just remember that they also just recently announced that they're buying out Rockstar. I really love Pepsi, I really love Coca-Cola, very similar business models, but in my opinion, Pepsi is a little bit more focused on the growth strategies than Coca-Cola is, but I love both of them. I don't know why these dividends don't show up here, but they did pay dividends during that time. They raise dividends every single year, have a great track record, and currently pay out about a 3% dividend, and they've already raised that dividend in 2020 as well. So Pepsi, a very easy buy there if you believe people are always going to need something to eat and something to drink. Now, I just lowered my position in Caterpillar by 1%. I did not sell Caterpillar, I just lowered my target weighting. And the reason why I did that was mostly to put capital towards WP Carey. But Caterpillar is a stock that I am very bullish on for the long term. But Caterpillar is a stock that makes a lot of the industrial stuff, a lot of the big machinery that you need for construction and oil sites. I think that Caterpillar could benefit massively if an infrastructure bill does get passed. I think that they'll probably be one of the largest benefiters on planet Earth from that deal. But regardless whether or not that gets passed, Caterpillar has great margins, they have great products, and a great management team that has got themselves financially healthy to fight throughout all recessions and continue to raise dividends for 20 plus years straight. Now, Caterpillar holded up raising their dividend in 2020, but they're still able to maintain it, which is pretty great considering we had the worst Q2 of 2020 in the United States history. But Caterpillar is a stock that I'm very bullish on for the long term with a great track record. Next up, we have McDonald's, 4% of my portfolio. Guys, it's funny because it reminded me, I just watched The Founder on Netflix, which, by the way, even if you're not invested in business with McDonald's, even if you're not interested in anything with the stock market, I think that The Founder was an awesome movie for pretty much about anyone to watch. And it's pretty funny because a lot of people think of McDonald's for burgers and fries. And while it is true, they make a lot of their money from the real estate that burgers and fries sells. Anytime you see a store that is McDonald's, it is more than likely owned by a franchisee and not by McDonald's itself. But what McDonald's will do is they will buy out that property, rent it to the person that's wanting to franchise it, and then receive a piece of the revenue that they make off of the business as well, and it's just recurring revenue every single month. Now, they continue to adapt consumer changing habits as people want to get more organic and more healthy, and they have adapted to more people closer to my generation, like coming up with an awesome app. They have a great app, by the way. But this is one of the largest investments by Warren Buffett, one of the largest investments by myself as well, not to compare myself to Warren Buffett, but they raise their dividends every single year, do a ton of share buybacks, grow revenues, and I think that McDonald's is going to be great for the long term, just like every one of these stocks. Now, next up for dividend stocks, we have Coca-Cola. I won't really go over this one. You probably all know it very well, just like Pepsi. It's 4% of my portfolio. I'm currently up 11.09% on it, or $11.51, and they're due for a dividend raise about 4 or 5 months from now. But Coca-Cola, same thing as Pepsi. If you believe that people are always going to need something to drink, then you can pretty much bet that Coca-Cola is probably going to be around a lot longer than me and you watching this video. Now, a need-based product that is up next is Kimberly-Clark, and I think that Kimberly-Clark is a great stock, and I upped my portfolio by 1% this month. Kimberly-Clark, I'm up 8.45% on it, or $7.11. Now, Kimberly-Clark is the largest producer of toiletries on planet Earth. Over 1/4 of the world population uses one of their products every single day. And Kimberly-Clark now has a 3% dividend yield, almost. Then their products include things like Huggies and diapers and Kleenex and Scott paper towels and tissues, a lot of things like that. Kimberly-Clark is just one of those stocks. If you believe people are going to need to wipe, literally, it's funny to say, but if you believe that people are going to need toilet paper to wipe their butts 50 years from now, then there you go. Kimberly-Clark is going to be the best benefit from that. It's the world's largest producer of those products. So Kimberly-Clark, growing dividend every single year, share buybacks, increasing revenues, very easy money stock, and they're due for a dividend raise in a couple months from now, same time around Coca-Cola. But next up in the portfolio, we have Discover Financial Services. Now, Discover Financial Services, I believe, is it the highest performing stock in my portfolio? Yes, it is. So, Discover Financial Services, well, I'm up 107% on it. Now, 107.48% is so much, and too bad I didn't make it a higher position in my portfolio, but I don't really worry so much about that. This is why I focus on dividends. I'm currently up $60.80 on it, and the reason why I'm not selling this stock is for one reason and one reason only. If you probably couldn't tell from these charts, I'm not really focused so much on share price gains. I will take profits every now and then and move some things around if things get too dramatic on the downside or the upside, but mostly I'm just focused on dividends. Now, it'd be really easy for me to say, oh my gosh, I'm up 107% on the stock. Let's go ahead and sell it and take some profits. But I'm really focused on that dividend. And the fact that this is a safe banking stock that is still yielding a 3+% yielder and is growing quite impressively, I am going to continue to buy shares of this company at these prices, and I won't really be selling it unless we see a massive spike upwards. Now, Discover Financial Services, I do have a pretty big bias towards. As a consumer, I love their products. I love their business model, and they have one of the best credit card services out there, in my opinion, which, by the way, link in the description if you're interested in signing up for a good beginner credit card. But Discover has some great services, and I love what they have to offer. Now, Store Capital. 25.86% is what I'm up on it, makes up 3% of my portfolio. $25.24 is what I'm currently up on it, and this stock is extremely undervalued, just pretty much like all three of my real estate investment trusts. They're all trading at rock bottom prices, and they're not really being valued the way that they should, in my opinion. Now, this stock just raised its dividends again. This stock is nearly back to its IPO price back in 2014. I believe it IPO'd around 20 bucks a share, and this stock is trading just a little bit higher than that. Now, they have way more properties, pay way more in dividends, make a lot more in profit, and they have one of the best CEOs, Christopher Volk, out there, and I think that the stock is going to be great for the long term. One of the reasons why it got hit so hard was not even for its revenue declines. It got hit so hard because it is a service-based real estate investment trust. Most of the properties that they own is service-based businesses, and people were scared about service-based businesses in 2020 with the recession hitting, but I think that people are undervaluing that stock. Now, I believe MO or Altria might be the only red stock. Yes, the only red stock in my portfolio based on the money-weighted return. If we go to Altria, it is the highest yielding stock in my portfolio. This stock yields 8.63%. I'm going to say it again. 8.63%. And they have a great track record of raising dividends every single year, and they just raised them last month. And this stock, basically the way I look at it, am I very bullish on tobacco? No. Does this company have a lot of debt? Yes. I'm not very bullish on the business model, but I think that they'll be able to maintain this dividend. So basically, if I'm right, if my bullish thesis is right about this company, as they turn around a lot of the negative sentiment around them, around Juul, their investment in Juul, I think that this company will continue to raise its dividend, and if I'm right, I'm receiving a 9+% dividend yield as I continue to invest in the stock, and especially if it sees more downside pressure, you might be buying the stock as a 10% yielding stock. 10%, guaranteeing yourself 10% yield if the stock able to maintain its dividend. But regardless, I am betting on Altria, much like an AT&T, to maintain that extremely high payout. Now, next up, we have Waste Management, 3% of my portfolio. I'm up 21.37% on it, and Waste Management has performed quite nicely throughout this recession. It has maintained most of its share price throughout this recession as it's recovered quite a bit from the March lows, but this stock continues to raise dividends every year, and basically one of my most bullish reasons behind this company is that they have probably the most safe business model in this entire portfolio. People are always going to create trash, and people are always going to need something to do with that trash. Whether that's businesses, families, individuals, people are going to create trash, and Waste Management is going to be there to clean it up. There's a reason why this is one of the largest investments by Bill Gates, and why it's a very good chunk of my portfolio as well. They have great financials, a great business model, and a pretty fast-growing dividend. So Waste Management, a great company there. A stock that I'm potentially looking at bumping up my position in is Procter & Gamble, a very safe old blue chip stock. 3% of my portfolio, I'm currently up 20.69% on it. And Procter & Gamble is a very safe long-term company that has been around since 1837. 1837, so almost 200 years. They make a lot of basic products that you take advantage of every single day, like skincare products and shampoos and deodorants and a lot of other things like that. And basically with Procter & Gamble, if you just walk down the aisles of Walmart, you'll probably see 10, 20, 30, 40, 50 products that are all made by Procter & Gamble that you probably don't even know is owned by them. So Procter & Gamble continues to buy out other brands and grow their revenues in the long run and increase the dividend in the meantime. But Procter & Gamble, a very safe, easy blue chip stock there. Duke Energy is the other utility stock that they own, and basically the stock is potentially look at getting bought out by NextEra Energy, and that's what this big jump up is right here. They went from about $82 to $90 in just about the last 2 days, but Duke Energy is a very safe, stable utility stock, basically the same thing as what I said with the Southern Company. If people are going to need to pay their electricity bill, then people are going to pay Duke Energy. Cisco is one of the largest food distributors of food products for restaurants and cafeterias and things like that. And Cisco has an impressive track record that dates back way further than 2020. Their dividends went from 31 cents all the way up to 45 in 2020, and I believe they're due for another dividend raise in just about 2 or 3 months from now. But Cisco Corporation, I think, is extremely hit way too hard from this recession, and I think that they're pretty undervalued at these levels. Either way, you got a safe, stable stock with great management that is going to continue to raise dividends just about every single year. So Cisco, a great stock to own there. Home Depot, another very blue chip stock that I'm up quite a bit on. 47% is what I'm currently up on Home Depot. And this stock has soared past the March lows. And I mean soared past to well past its previous all-time highs. Before the recession, it had an all-time high of about $247, $248. And today alone, it trades at $280. And at one point, this almost floated around $300. This stock raises dividends every single year, and an impressive dividend growth from 59 cents up to $1.50 in the last 5 years, and they're due for another dividend raise in the beginning of 2020. So let's see how big that is, as people expected this stock to actually downturn from the recession. People spent more on home improvement than they have ever before. So Home Depot has been thriving throughout this recession. I wish I would have made this stock my portfolio 3 or 4% rather than just 2, but oh well, I still own this company and I benefited from some of the profits from that. Honeywell is a stock that is also 2% of my portfolio. I'm currently up 23% on it. Basically the same story as 3M. They make thousands of different products in all different categories. If the economy grows, if the population grows, and this company is going to continue to raise dividends and increase profits every single year. Very easy money stock, and they just raised their dividend from 90 cents up to 93. So the next payout will be a little bit higher than it is now, but regardless, it's over a 2% yielder, and they're a very fast-growing industrial company. A very high-yielding telecommunications company is Verizon, much like AT&T, but with a little bit better financial state. Verizon is basically, if people are going to need cell phones and their services, then Verizon is going to be the stock to benefit from that. And they also raised their dividend just last month as well, so that payout will be increased as well. But over a 4% yield, and while it's not going to be growing massively, and I don't expect very large share price gains, a 4+% yielding dividend stock is going to be very safe and stable to grow your cash flow quite significantly. So Verizon, a very high yielder there. Now, if we look here at Starbucks, it is actually the lowest payout in my portfolio. If you see here, actually if we scroll to the left, it is the lowest on the dollar amount, only making up $2.04 worth of annual dividend income. But the reason why I own Starbucks is not so much for the dividend. It's a mixture of the dividend growth and the potential share price growth that I think is going to happen over the next 5 and 10 years. Coffee is a very high growing category. One of their highest competitors, Luckin Coffee, has pretty much been wiped out. And another thing that I love about Starbucks is they have one of the best management teams around, and they are growing at an incredibly rapid pace. And another thing about Starbucks, I made an entire video dedicated towards them if you're interested, but Starbucks does not franchise its stores. Like McDonald's, when I was saying, McDonald's does not own hardly any of its stores, it franchises them out. Starbucks owns over 99% of them. So if you're investing in Starbucks, they own about 99% of the stores that they have by the corporation, and they just license out stores to potential people that are interested in investing in them. But Starbucks is a great dividend growth stock there, and I think a lot of people should own it. NextEra Energy Partners, like I said, NextEra Energy is looking at buying out Duke Energy, but basically they're like the little cousin of NextEra Energy, and this is NextEra Energy Partners that has currently a 3.5% dividend yield that raises its dividend every single quarter, including this one. And NextEra Energy is going to be a stock that is focused on renewable energy, taking advantage of the shift away from crude oil and fossil fuels and things like that, as we get more into things like clean energy like solar panels. NextEra Energy has a long-term growth potential in my opinion. Now, next two stocks that we have are the last two in the portfolio, 2% making up Qualcomm. Qualcomm is a stock that is taking advantage of 5G. Their number one partner, making up the mass majority of their revenues, is from Apple. This company is similar to Avgo, to Broadcom. I think that this company is not quite set as good as Broadcom is for the future, as they rely a little bit too much on Apple, but they make microchips, they have great margins on it, and they grow that dividend quite nicely, as well as the share price gains every single year. Qualcomm has a lot of potential as 5G ramps up, and I think that the stock is going to perform very well over the next 2 years. Last but not least, we have 1% of my portfolio. Same thing as what I said, like an Altria or a Verizon. An extremely high yielding stock with a lot of risk, but who knows if they're able to maintain that payout, if their horrible management team is able to flip things around, you'll get some incredible cash flow as well as hopefully a little bit of share price gains. I've been buying this stock in the 20s and the 30s. I have not been buying it in the 40s and 50s up here. but buying it at these prices has a little bit of chance for upside opportunity, and I own it at $28 a share, almost exactly what it's trading at today. But overall, guys, that's the 27 stocks in my portfolio. If you want to support me in the channel, like I said, if you want to see me update these numbers every single month, if you appreciate the transparency of me disclosing my YouTube income and everything in my portfolio, every single video, one of the ways that you can support me is to use this link down in the description. And like I said, other things in the description as well, including mentoring calls, Yada savings accounts, credit card referrals, scheduling stuff with me, anything you need to know, all down there in the description. Thank you guys so much for watching, and I will see you guys next time.